Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and we're getting an update today on Arizona Sonoran copper, traded on the TSX under the ticker ASCU and on the OTCQX under the ticker ASCUF. And we're joined today with the president and CEO of Arizona Sonoran Copper, George Ogilvie. And George, it's great to get you back on the show for an update. I've been excited to get you back on the show to talk about the standalone PEA that you put out really at the end of August on the 27th. And this is on the Cactus Project in Arizona. This has a whopping NPV8 of $2.03 billion and an IRR of 24%. And this is an update to the prior PEA where you're really doing this on the whole project now. So you've got the Cactus Project in there, you've got Parks-Salyer, you've got MainSpring. So everything's pulled together into this new preliminary economic assessment. Walk us through some of the key highlights and takeaways for investors, and then we'll dive into it and get under the hood.
Hey, thank you, Shad. Yeah, so obviously we're delighted with the results, with the mine plan and the schedule that we've now put together within this PEA. 94% of the tons that will now be mined actually come from open pit mining. So that's helped us further reduce the capital intensity. We're now seeing average annual production of 86,000 short tons of cathode production a year. And the mine life has been pushed out now to 31 years. And within those economics that you described, I think another key point is that the long-term flat copper price in the financial and economic model was set at $3.90 a pound of copper, because we wanted really to show an apples to apples comparison versus a PFS that we put out in February of this year. So we've seen a dramatic uplift in the mine plan and the financial and economics. And look, that is predominantly due to bringing in MainSpring into the asset mix. This is a deposit that is the southern extension of Parks-Salyer. We only gained legal title to MainSpring in March of this year, and it was only drilled out into an inferred resource by the end of April of this year. So that's why now we've put out this PEA as an update to a PFS that went out just 5-6 months earlier.
Well, let's talk about that, George, because there's been a couple comments that it's been confusing for some people to track the progress because you had a PFS and you went back to a PEA. But to your point, MainSpring is a really new discovery and a really new deposit that you just got title on. And so that's a key component to how this mine plan has changed. And so has the thought process on how you'd even mine this and how you could go to the bottom of the pit. So maybe just explain how the mining sequence has changed.
Yeah. Well, it's a great point, and it's a fair point. I hear that a lot, that it's a complicated story. It has been evolving over the last 3 years since we IPO'd the company. And remember, back then, it was really just about the rehandling of a historical surface stockpile that was a remnant from the ASCU mining days back in the 70s and 80s. At that time, the initial resource was only 230 million pounds of copper in a low-grade, sulfide stockpile. Since then, we drilled around the open pit at Cactus West, which was the old Sacaton mine. And of course, we added additional resources to that, including Cactus East, which was known by ASCU, and that upgraded the resource to 3.5 billion pounds of copper in all classifications. And on that, the private company, Elim Mining, basically, founded the company with an IPO. That was the qualifying document. We had an initial PEA of 18 years and 28,000 tons of cathode production a year, but it didn't really excite the market, and it wasn't really going to go anywhere unless we were seeing much, much higher copper prices than the $3.90 that we have in our latest financial and economic model. And then since then, we discovered Parks-Salyer. We drilled that out, and it came in an additional almost 3 billion pounds of copper, close to 1% total soluble copper. But the only way to access it was as an underground mine. And that came out in the PFS this year, where, half of our production was going to be underground mining, which obviously carries a higher capital intensity and a higher execution risk. But we were obligated to put those reports out because as we find more mineralization and move it into higher classifications, it becomes material and we have to update our technical reports. And then, of course, as I said, we knew that there was an opportunity for acquiring MainSpring. We only became legal title to that in March of this year, and it was only drilled out as an inferred resource. So again, we had to bolt that on. We knew it was material, but because it was only an inferred resource, we had to go back to a PEA and renounce the reserves that we had previously declared. The good news, I think, from here, Shad, is that going forward, with 11 billion pounds of contained copper in the ground in all classifications, we now have a very, very solid basis and foundation for building a solid copper mid-tier company in the heartland of the Arizona Copper Belt. I'm quite sure we're going to continue to add resources to that number. However, the first 10 or so years of the mine life is now unlikely to change. And as we all know, that really drives the economics in a discounted cash flow model. So I think we've got a generational mine here that we'll see improvements on going forward, but the main fundamentals are not going to change as the mine plan now is essentially cast in stone.
Well, let's dive into the mine plan a little bit more because now you can actually treat MainSpring as the open pit, and then by the time you're down to the bottom of that pit, you can drift into Parks-Salyer. So just talk about how that's kind of a game changer as well.
Well, that's been the main transformative action here. So MainSpring is about 900 meters of extension from the Parks-Salyer boundary to the south. MainSpring, the mineralization comes within 42 meters of surface. So it allows us in this new PEA to start MainSpring as an open pit in the south. And then as we advance to the north with the north pit wall, the mineralization gradually gets deeper. And eventually that brings us all the way into Parks-Salyer. And because we can economically mine at $3.75 using that for our pit shells to get down to Parks-Salyer, given that we've then removed a substantial portion of the overburden that we were previously looking at Parks-Salyer, but it's bought and paid through from MainSpring, it now allows us to mine Parks-Salyer as an open pit. So suddenly our mining costs go from, $25 a short ton for sub-level cave mining to something that's slightly below $3 a short ton mining cost. And because there's less sustaining capital on an annual basis with an open pit, so for example, for an underground mine, you've continually got to put in ore passes, waste passes, ground support, footwall drifts, ventilation raises, etc., etc. You don't need that in an open pit mining scenario. So the annual sustaining capital also goes down. And the upshot of that is that then allows us to lower our cutoff grades for open pit mining. It means that additional resources can come into the model. And of course, it makes a transformative jump in the production profile for the company. And that's really why we were able to see a further uplift from the PFS 6 months ago to the production of this PEA in the last several weeks.
Now, do you think that at one point when you've mined a lot of that with the open pit, both MainSpring and Parks-Salyer, that you could still go underground and still dig into some of those sulfides at depth?
There is a possibility that could occur. The primary sulfides are cut off at depth. There's a very large oblique fault system here, which we call the basement fault. We've drilled through it, and on the other side of the basement fault, we see that it's barren. There's no mineralization. So eventually there comes a point where mining would cease, but depending on the copper price at the time, that is a possibility. But we're looking already now at a 31-year mine life and very robust production profile. That's something that's going to be well beyond year 30. And obviously we're looking at a generational asset if that were to come into the play. And I think George Ogilvie will be long retired and maybe even long gone by that point in time.
That's a good point, George. 31 years is already a very long mine life, but you've got even more drill results that just were released on September 16th, showing that the resources are continuing to grow. You put out 17 drill holes, about 9,000 meters of drilling, a little more than that, and it just shows that there's even more action down in the sulfide. So maybe walk us through how the resources could actually take it beyond 31 years.
Well, those drill results we put out are related to Cactus West. Cactus West is not the core of our first 10 sort of years of mining. And the primary sulfides that we're referencing here in this current plan only come into play currently in year number 15 and beyond. So we know when ASCU had this operation and they were mining the Sacaton mine, or Cactus West as we call it, open pit, it was a very, very marginal operation. And remember, in the 1970s and 80s, copper would have been 60, 65 cents a pound of copper, not the $4.25 that we see as the spot price today. So ASCU didn't drill out the resource to the full extent because they didn't need decades of reserve and resources, given the mine was so marginal. So when they were mining on the benches, they only drilled 200 feet or approximately 60 meters below whatever bench they were actually mining. So subsequently, they would have had only 1 to 2 years of reserve and resource ahead of their mining face, so to speak. So now that we've received additional monies from Rio Tinto and Newton, and we're targeting primary sulfide, we've been drilling around the Cactus West open pit, and we're finding a lot more primary sulfide below the current resource shell and to the southwest of the resource shell, heading back towards Parks-Salyer. So we believe strongly that over time, as we continue to drill out the primary sulfides around and below the current Cactus West resource model, there's a high likelihood that we're going to add additional pounds of copper to the resource and eventually reserves, and therefore the mine plan. It won't make a difference to the financial and economic model because this is something that's coming in beyond year 15, year 20. So when you discount to 8%, once you go beyond year 10 or so, it makes no impact to the financial and economic model. But if we had seniors or mid-tier other corporates looking at this asset, potentially adding another 1 to 2 or 5 billion pounds of copper, whatever it's going to be, and giving the mine either more longevity or able to mine at a higher production rate, certainly would be very attractive for, you know, producing companies today that potentially might have an interest in this asset.
You bring up an interesting point there, George, that in general, when you're using the discounted cash flow metrics and an NPV8, you're not going to get a lot of credit after year 10. But when you think about copper projects, they are generational assets. They do run decades. To your point, it's already 31 years. So it's already 3 decades. It could go longer. Maybe it goes 4 decades. Should we, as investors, be evaluating copper projects differently than, say, a gold project that maybe only runs 10 to 12 years? Should we be using a different model to evaluate the true value of these projects over long periods of time, not just 10 years?
I think that's a true statement, Shad. I mean, certainly, I think you would use a discounted cash flow model, but I don't think you'd base your investment decision just on that. As you rightly pointed out, these copper porphyry systems tend to be generational mines that go on for decades. I mean, some of the larger mines in the world today that are in production in Chile and Peru, the number 1 and the number 2 copper producers in the world, have been running for 50, 60, 70, 80 years. And, you know, if they were discovered today and you tried to run a discounted cash flow model on them, given the amount of capital that would have to go into those mines, you probably, on a DCF model, would make a decision not to invest, which I think is completely the wrong decision if you're bullish on the supply-demand fundamentals for copper going forward, with the world looking to decarbonize, move away from fossil fuels, the drive for green energy. You know, we've got all this artificial intelligence coming now in data centers, electrical vehicles, et cetera, et cetera. So I do think we need some other tools in our toolkit, so to speak, to assess generational copper mines other than a discounted cash flow model for sure.
Well, and I guess just walk us through some of the key steps that you'd still need to do on de-risking as you move towards your PFS next year. And could you weave into that discussion some of the permitting, where you're at in that process, as a lot of investors are zeroed in on what the permitting timelines look like?
Yep. Well, look, I mean, given that we just brought MainSpring into the asset mix, the amount of metallurgical work on that deposit is minimal. So we've got a lot of work ahead of us over the next 9 months to do additional column tests on MainSpring. In totality, between MainSpring and Parks-Salyer, I know there's 20 columns which are either currently underway or being planned. So that work needs to obviously, be ongoing. MainSpring is only an inferred resource drilled out to 500-foot centers. The geostatistics and the variograms tell us that for that deposit, we need to drill that off to 250-foot centers to get it into at least an indicated resource of our next standalone pre-feasibility study, which we would anticipate coming to the market in the summer of next year. So there's one drill that is mobilizing onto MainSpring as we speak. Next week, I would anticipate a second drill would be moved there. And then as we finish up the drilling program of the primary in mid-October, the third drill will be moved over to MainSpring. And by the end of October, we should have 3 drills going hard on MainSpring to move it up into an indicated resource in the second quarter of next year. We've just tendered the PFS technical report itself. We went out for bids on that, but we just awarded the consultancy to M3, which was the same consultancy group that overviewed the PEA that just went to the market. And of course, they're going to be supported with various subcontractors, including AGP consultants who did all the mine planning and mine scheduling work for us.
Well, and as far as the permitting, do you have to wait for the PFS to be able to start the environmental impact study, or is there other permitting you have going on in tandem?
Yep, so there's no environmental impact study required here because this is a brownfield site and all of that would have been done back in the 1960s and 70s when the mine was initially discovered and brought into first production. Remember, we're all on private land here. There is no federal nexus. So anytime we apply for a permit, once the application is administratively accepted, it starts a clock ticking, and within 6 months, the regulator must give us a response to our permit. So as per that original PEA from 2021, the mine is fully permitted today for 28,000 tons of cathode production and an 18-year mine life. But as we discussed, based on the chronology and the discoveries that we've made, obviously we're looking at a much, much bigger production profile now and a longer mine life. We have actually submitted the amended permits for the aquifer protection permit and the industrial air permit based on the PFS that we put to market in February. Now, you might ask, well, why do that when the PFS now basically is no longer valid and you're looking at a much bigger mine than that? And of course, now you're shifting from underground mining to open pit mining. The reason why we want to do that, Shad, is we always get asked about permitting. And in Arizona, the way it works, when you make an application and the various regulators dedicate time to that, they actually invoice industry for their time. So we're happy to go through this process. They provide us with continual feedback. And of course, if they see any issues or challenges, we can then tweak our future permits. And by following this process as well, nobody essentially is blindsided. So we believe by late this year, early next year, we will have another set of amended permits that we'll be able to come to the market with against the PFS that is no longer applicable, but we'll be able to show the market that from when the application was administratively accepted to receiving the permits, it was within that 6-month window. And hopefully that gives the market further confidence that when management says they can get the permits on this project, we can actually deliver on that. And it was very pleasing for me a couple of weeks ago to see Hudbay's Copper World actually get their aquifer protection permit. Obviously, they're on private land like ourselves, and the two projects are essentially proxies for one another. And they got that amended aquifer protection permit in record time. And I think that bodes well for an amended permits for our final permits in 2025 that we'll be going after.
Well, and just one final question here, George. We haven't really dove into the Newton technology that Rio Tinto has for possibly processing the sulfides in a more efficient way. But this is just another kind of an icing on the cake factor. Maybe just share with people that are not familiar with that in a minute or so how that Newton technology could be yet another value driver down the road on this project.
Yep. So the phase 2 column tests are starting up in Bindura, down in Australia, which is their testing facility. In 2023, we put out the results of the phase 1 column tests, and we saw recoveries of copper from the primary sulfide, in this case chalcopyrite, of somewhere between 70 and as high as 85%. So in this PEA, where we are treating primary sulfides using a conventional leaching, we've got the recoveries in at a conservative 25%. So if Newton continues to prove successful in the phase 2 column tests, and ultimately Newton in an integrated Newton PFS that'll come to market at some future juncture, if that can see a 1.2 times uplift to our base case PFS, then obviously Newton would have the option to earn in on the project at the asset level for potentially up to 40%. And at that juncture in time, we would be looking at much, much higher recoveries of the copper from the primary sulfide. It brings more copper to the table, but as we discussed earlier, based on the fact that it only comes in from year number 15 and beyond currently, it won't have a huge impact on the NPV or the IRR of the project, but it will add to the longevity and the pounds of metal copper that we're actually bringing to the table here beyond year 15.
Well, a lot of exciting catalysts coming up for the company, a lot of testing going on, a lot of drilling going on, a lot of met work, and ongoing work to crystallize into the PFS for next summer. So, George, definitely appreciate you giving us an update on Arizona Sonoran. And if people that are following along with this interview would like to follow along with the news flow in real time, definitely click on the link below this interview. It takes you right over to the company website, straight to their news section, so you too can follow along with the news as it hits the wires. And George, keep us posted as more information comes out. We'll get you back on for an update, and looking forward to our next conversation.
Thank you, Shad.